Welcome, folks. We're going to give people another minute as they come in, but we're thrilled that you're with us today. We'll be starting in just less than a minute. Again, welcome, folks. We appreciate your joining us. We'll be starting in just a few seconds. Thank you for your time. Welcome. Hi, my name is Stephen Rothstein. I'm the Managing Director of the Ceres Accelerator for Sustainable Capital Markets. First, thank you for your time today and for all of the work and partnership from so many people on this webinar. We are really excited about the topic and the incredible panel that have joined us today, and the fact that all of you are with us today. Want to make sure that there will be time for questions, and you can put them in at any time in the Q&A button. We won't get to them right then, but it's good to have them. So please feel free at any point. Next slide, please. Many of you we've worked with at some point, but for those we haven't, Ceres is a nonprofit. We have four main buckets of work. Our company network, which work with some of the largest companies in the country on their sustainability journey. Our investor network, where our investors collectively have $60 trillion of assets under management, again, helping them on their sustainability journey. The policy network, working both on Capitol Hill and in many states. And then the accelerator, focusing on the financial sector, including the insurance area. But enough about Ceres. Next slide. As I said, we have an incredibly distinguished group of speakers. First, in just a minute, you're going to hear from the Connecticut Insurance Commissioner, Andrew Mays. He's not just a commissioner there, but he is the incoming president of the National Association of Insurance Commissioners next year. So he's a real leader, both at the state and federal level. Then after him, Carolyn Kuski is going to speak. Carolyn is the prime author. And while she's not speaking today, I also want to recognize Karina and appreciate all of her great work. Carolyn is the Associate Vice President for Economics and Policy at EDF, and appreciate all of her brilliance and effort. Then we have our three distinguished panelists. Yomi Chu, as you'll see, the Senior Product Manager from Swiss Re. Reese May from SBT, the Chief Strategy and Innovation Officer. And then Professor Daniel Schwartz from University of Minnesota School of Law. You're going to hear from all of them in just a few minutes and really appreciate their time and their expertise. But first, I'm going to turn to Commissioner Andrew Mays. Next slide, please, for his introductory remarks. Commissioner, the floor is yours.
Thank you for having me open up this very important discussion. Ceres, in collaboration with the ESG Initiative and the Wharton Climate Center, the Wharton School, released a new report finding that the U.S. insurance industry provides inadequate coverage for climate-related disasters and does not meet the needs of certain populations. Led by authors Carolyn Kuski and Karina French, the report, which is titled Inclusive Insurance for Climate-Related Disasters, a Roadmap for the United States, examines the role of insurance in recovery from climate disaster across socioeconomic groups in the U.S. The report findings are that low to moderate income households and communities of color are unfortunately disproportionately affected by climate disasters and more likely to experience financial shocks, but do not have the financial savings or the insurance to cover them. The report provides actionable guidance for federal, state, and local leaders, as well as insurers, to expand the financial protection of insurance to those whose needs are not currently met by the market, and make disaster insurance more affordable, accessible, transparent, people-centered, and just. As a regulator, I understand and I have seen how climate is a growing issue, and not in a good way. Coming from a state with the second highest percentage of insured property in the country along the coast, Connecticut has long recognized the importance of climate change and the need to work with our government and industry partners to address this threat and preserve our world for future generations. The Connecticut Insurance Department is focused on having the industry better manage their financial risk because of climate change. Since 2021, we have hosted the Connecticut Conference on Climate Change and Insurance. We have heard some of our nation's foremost experts on climate change, including Carolyn Kuski, to lead this critical discussion. And this discussion will focus on climate resiliency, on risk mitigation, and on what the insurance industry is doing to create more resiliency and adaptation in our communities. The recent devastation from Hurricane Ian in Florida is a prime example that more work needs to be done on behalf of consumers. Ian was 2022's most expensive natural disaster with estimated preliminary insured losses between $50 and $65 billion. Ian brought unprecedented destruction and monumental losses to homes and businesses, forcing insurers to reconsider their participation in that market, raising premium rates for new policies out of reach of most consumers, withdrawing from the market, or having to face insolvency. None of this helps the area recover anytime soon, nor does it support what we all want, a healthy, competitive market full of choices for consumers. Yet, the good news is these weather patterns and the storm surges of this magnitude can be mitigated. Our homes and our businesses can be better protected. Back home in Connecticut, we do track our efforts on climate change. The department submits a report to the legislature that outlines our agency's progress towards addressing climate-related risks, monitoring greenhouse gas levels, and bolstering the resilience of insurers to the physical impacts of climate change. We were also one of the first states to join the Sustainable Insurance Forum, a global leadership group of insurance regulators working together with the UN to strengthen understanding and responses to sustainability issues. And just this past year, the Connecticut Insurance Department published a bulletin providing guidance toward domestic insurers on how to better manage their financial risk from climate change. Although climate disasters impact all of us across the country in some way, we all must work to address how it impacts low to moderate income households and communities of color more acutely. In a sense, I do believe we are all our brother's keepers, and that is so very important here. From having the financial flexibility to stay in a hotel following climate-related damage to a home, to having insurance coverage for costly repairs, climate-related disasters are more likely to pose a financial shock and crisis to these socioeconomic groups. And as climate disasters continue to prove a growing risk to these mid to lower income populations, it is communities of color who continue to face challenging times and inadequate coverage. The private and public sector together need to think creatively about solutions to fill this coverage gap. And this report includes a lot of effective and promising ideas for the market to consider. The industry overall must examine and evaluate more inclusive insurance options. This report identifies more than a dozen ideas for federal, state, and local governments, and for the private sector. We hope that everyone seriously considers these recommendations and determines what can be adopted, whether as pilot projects or incorporating parts for implementation. We need to urgently address this insurance coverage gap because the problem is only getting worse. I want to thank Ceres and the authors for this important work. Steve?
Commissioner, thank you. Thank you for those thoughtful comments. Thank you for your leadership within Connecticut borders and nationally, and as you highlighted, internationally as well. I also just want to thank all of the Ceres colleagues, especially Monica and everyone else who's worked hard on this. Now it's a pleasure to have Carolyn come up and give a brief summary of the report. Carolyn?
Great. Thank you, Stephen, and thank you, Ceres, for hosting this. And thank you again to Commissioner Mays for that wonderful introduction to this topic. I'm just going to provide some high-level findings and reflections from our recent report, and then let the panelists provide their comments. So today, I want to leave you, I think, with three key takeaways that we took from this work. The first is that disaster insurance is absolutely critical for recovery. There's no substitute to insurance for households to have the resources they need to overcome the negative shock of a disaster. That said, right now we see that too many people are uninsured against disasters. They can't afford disaster coverage. They can't find coverage that meets their needs. In addition, we see concerns about procedural inequities in navigating the entire insurance value chain, but especially in the claims processes. But despite those difficulties, there are, to end on a more optimistic note, many new public policies, regulatory changes, and innovative new products and partnerships that can help bring the financial protection of insurance to a wider population and to cover more of our disaster needs. Of course, the motivation for this work that everyone on the call is probably familiar with is the escalating cost of weather-related extreme events in the US. The Federal Reserve estimated that in 2021, 1 in 6 adults were directly affected by a natural disaster. And as these trends continue, that number will probably only go up. As the commissioner noted, we think of these disasters as negative financial shocks to households. They are times where they face all of a sudden a huge increase in expenditures. And that includes, of course, substantial property damage to their home, contents, and vehicles. But it also includes a wider range of costs. And that is something we heard over and over again in the interviews we conducted for this report, and that you can see in this chart here, which is from recent work with a colleague at Freddie Mac, based on some surveys of people recovering from 4 recent landfalling hurricanes. And you can see the range of expenses that households face is quite large. Beyond the property damage, it's dealing with service disruption, having to buy supplies. A loss of income as well can happen for households due to business interruption at the same time they experience this increase in costs. So how do households cope with this? Well, there's essentially 4 buckets of funding or financing that households can turn to after a disaster, but we see that many households struggle with all of these, but lower income households and communities of color can disproportionately struggle with access. So starting with savings, most households simply do not have close to enough savings to cover the tens of thousands, hundreds of thousands of dollars in damage they might experience from a severe disaster. A quarter of consumers have 0 savings to draw on in the case of an emergency. The first line of defense for survivors of a disaster in the US is a loan, and that can be helpful for more affluent families, but we find that lower income households are often locked out of access to credit entirely. When we look at approval rates for the federal disaster loan program, for example, approvals go way down as income goes down. These are households that simply can't afford to take on more debt. Without savings or loans, households can turn to the federal government, but we know that assistance for some types of events is not available at all for households. And when it is available, it's actually pretty limited and restricted or can come too late. So because of the limitations in these 3 sources, that's why insurance is really important for people in order to have those resources they need to cover this financial shock to the household. And there's actually a growing body of research that finds that people with insurance are more likely to rebuild. They report fewer financial burdens in both the short and longer run. They report fewer unaddressed funding needs. There's also research showing that lack of insurance can drive increases in inequality post-disaster. So insurance plays this really important financial protection service for households, but despite those documented benefits that insurance provides, we see that too many people are uninsured against disasters or can't find coverage that meets their particular financial needs. In the report, we document these kind of barriers to inclusivity, and they take a number of forms. Many households at risk, as I said, simply don't have disaster coverage at all. Some disasters like flooding are completely carved out of standard homeowners policies, but we also see limitations on the coverage that is providing, including things like sublimits for certain types of damages, higher deductibles when it comes to disasters, things like hurricane deductibles. Oftentimes, complementary coverage for this can be purchased. You can purchase a separate flood policy or put riders onto your standard property policy to cover more of this. But that gets to the next challenge, which is that lots of people simply can't afford to do that. And on top of having to buy multiple products to get comprehensive disaster coverage, disaster insurance is fundamentally more expensive than other types of insurance. And that puts it financially out of reach for the households that really need it the most. We also see that some needs, particularly non-property losses, so things like we heard in the report, covering higher rent after a disaster. Housing can be a huge need post-disaster, and those types of needs are not well met by our current products. Finally, while we heard that direct discrimination in the market may be limited, there are concerns about indirect discrimination, and that includes things like the procedural inequities in accessing fair claims payments, the rising use of machine learning and AI for pricing, correlations between climate risk and race or income, particularly since the cost of insurance is not just related to the underlying hazard, but the likelihood of damage. And that can be influenced by historical divestment in neighborhoods infrastructure, and the inability of communities or households to invest in protective measures or in deferred maintenance due to lack of funds. So all of this means that our system might not be meeting everyone's needs right now. So we turn in the report to how to build a more inclusive disaster insurance system. And we define that as the policies, programs, and products that make appropriate and affordable insurance available to those who are currently unserved or underserved by the market. We propose that an inclusive insurance system should be affordable. That's straightforward. It should be accessible, meaning people can engage with the markets easily, products deliver payments smoothly, information's available in multiple formats and one's native language. It should be transparent, meaning that policy terms and claims processes are clear to consumers ahead of time. They don't learn about limitations to their coverage at the time of rebuilding. And also importantly, that market data is available for public and academic research. It's been very difficult to even understand the extent of things like differential impact in certain areas because of a lack of data and research. It should also be centered around the specific financial needs of individuals and households, and just, by which we mean no direct discrimination and minimizing differential impacts. Luckily, there's a whole range of policies that can be adopted to help achieve these goals. We think of this a bit like a puzzle. There's not one silver bullet, but all these different pieces coming together can create a much more inclusive system. In the report, if you take a look at it, we've grouped some of these policy interventions by which type of decision maker can adopt them. So we look at interventions that require new federal or state legislation, regulatory actions, things that communities and local governments can do, and also opportunities for the private sector. To wrap up here, I'm going to just, instead of going through all those, just address three big topics and the range of policies that might help with them. So first, affordability, as I've stressed, is a really important challenge. And there's long been proposals to have direct public assistance for this, like a federal means-tested assistance program for the flood insurance program, which I think has been introduced in Congress every year for maybe a decade or more, but hasn't passed. We've also seen examples for this at a state level as well. Beyond direct public support, as the picture you can see there, we looked at some interesting local government policies that were more high touch with households, helping provide them with specific individualized guidance on the type of insurance they need, right-sizing their coverage, and making sure they take account of all the possible discounts they can. It's also the case, of course, that insurance prices are higher when the risk is higher. So if we can target our mitigation grants to the households that have really been unable to invest in lowering their risk due to lack of resources, we can also hopefully improve their insurability and lower their insurance costs. And then I want to note that the way we're handling this in the United States is not the only way to think about it. And a more radical change in the way we approach disaster insurance could also begin to address affordability. So for example, some countries in the EU take what's referred to as a solidarity approach to insurance. They mandate that all natural hazards be included in standard property policies so that everyone has the complete financial coverage they need to be protected against these events. Of course, that creates a huge bankruptcy risk for insurance companies. And so the federal government is a backstop to insurance companies. So the kind of deal is they provide the coverage, and in response, the federal government makes sure that they don't go bankrupt after a big catastrophe. So these are some ideas around improving affordability. I also wanted to highlight that we're seeing lots of new innovation in the insurance products being offered to meet some of these needs that we've identified. So for example, community groups or local governments could help secure coverage on behalf of a population. Or we've seen interest in microinsurance, which has been used Globally, these are small limit, small premium policies that pay a very set amount immediately upon some type of disaster happening. So the dollars can get to people very quickly to meet immediate needs. Puerto Rico is the only place in the US that has sort of a robust microinsurance market at the moment. And of course, we see new mobile-based models and other platforms that can help meet needs and rein in costs. But this innovation could really be pushed along faster through support from policymakers and regulators. So whether that's enabling the market through the regulatory framework that might need to be a bit different from other types of products, like we've seen in Puerto Rico with microinsurance, or maybe creating regulatory sandboxes to work together, the regulator and companies, to innovate on what types of solutions might work to meet some of these populations that are currently left out of the market. Or maybe we need more incentives, something like an insurance version of a Community Reinvestment Act. And the last point I wanted to make is around issues of data and transparency and leveling playing fields. As I noted, right now, there's just not sufficient data to undertake the research necessary, despite the fact that there's anecdotal evidence that there might be areas of concern and differential impact in the market. So we need more research. But right now, the data is not available to do that. So Daniel on the panel can say a lot more about this and actually all the things on this slide, since it draws heavily on his scholarship and policy suggestions. But one idea is to come up with something akin to the Home Mortgage Disclosure Act, which has made mortgage data available to private and public sector researchers as well as regulators. In addition, we need increased transparency around policy terms so consumers understand ahead of time what they are and are not covered for. And it's possible that that might be difficult to do just around transparency, given the huge amount of fine print and exclusions and sublimits and everything we see in these policies. So it might be necessary to create baseline coverage standards to make sure that when you buy a homeowner's policy, for example, everyone has at least a certain amount of coverage. And again, Daniel can speak to some ideas as well to reform the claims contestation process so that it's not the case that only well-resourced households are able to get fair claim payments. And then finally, if we can improve transparency on the savings that could be gained from mitigation, we might be able to do a better job of linking risk reduction and risk transfer. So that's it for me. I'm now going to turn it over to our panelists. I think, Reese, we're going to start with you.
Well, thanks, Carolyn. You're a very difficult act to follow. I'm thrilled to be a part of the discussion today and humbled to be a part of the panel. My name's Reese. I'm the Chief Strategy and Innovation Officer for SPP. We began St. Bernard Project just southeast of New Orleans a few months after Hurricane Katrina, where we were rebuilding for precisely the low-income populations that we're talking about, folks who own their homes. They didn't own any other homes. They couldn't afford market rate contractors, and they didn't have insurance because they couldn't afford insurance. We went on doing that work for folks in St. Bernard and New Orleans, later in Joplin, Missouri, and New York City, where I'm calling in from today, and Texas and South Carolina and West Virginia, and in all those places. While we were rebuilding houses, we saw the many ways in which the folks who are waiting on our rebuild services might have been served in some other way by the disaster preparedness or recovery system. And so as an organization, we stopped counting how many homes we could rebuild, and we started intervening in 5 strategic ways. So we build houses, we'll always do that. We share our resources with other organizations in at-risk and impacted communities. We do a lot of preparedness work. It's why I'm excited about the discussion today. We advise state and local government leaders who are implementing long-term preparedness and disaster recovery programs. And then we advocate for legal and policy regulatory reforms that will enable us and other actors to reduce the time between disaster and recovery for the most low-income citizens. So I'm thrilled to be part of the discussion today. I think that innovation in the insurance sector is incredibly important, and that closing the protection gap is the only way we can ensure that low-income Americans get the resources they need immediately after disasters. I'm thrilled to share some of the experiences of our organization and clients, and happy to be a part of the panel.
Thanks, Reese. Daniel?
Thanks so much. I also really appreciate being part of this panel and the extent to which it intersects with work I've done for some time. So in my brief remarks right now, I just want to highlight a few of the issues that are mentioned, the suggestions that are mentioned in the report, and talk about where folks can find more information, because a lot of these questions and issues are really immensely complex, and we can't possibly do justice to them in a few minutes. But I think the key thing to understand is that there's a lot of information out there. So If you look at some of the proposals that are included in the report, I want to highlight 4 of them that I've done some work on, and each one of them is associated with multiple very lengthy law review articles that folks can look up and that are cited in the report. So the first is, even though we all recognize that the availability and the affordability of insurance products is of vital importance, there really is remarkably little data that's publicly available regarding how available and how affordable insurance is for low-income folks, for folks who are particularly vulnerable. And that's surprising because we actually have a decades-long legal framework in the banking sector, in the mortgage sector, for making that type of data available through the Home Mortgage Disclosure Act. Now, there are obviously differences between insurance and mortgages, but at the very least, what HMDA has done is facilitate a tremendous amount of research and understanding of that market to understand where we need interventions and what types of problems exist. Of course, the insurance industry has legitimate concerns about the availability of data, but right now the balance has tipped almost entirely towards the unavailability of data regarding the availability and affordability of home insurance products and other property insurance products. And if we're going to really solve these problems, we need better data. We need more understanding of where insurance products are available, what the costs are, and we also need data, frankly, that is disaggregated by company, so we can understand which companies are serving underserved areas and what their strategies are, not in terms of undermining their competitiveness, but in understanding how we can facilitate that process. The second piece that is mentioned in the Actions for a More Inclusive Insurance System is establishing baseline standards of coverage. Right now, there's quite remarkable variation and increasing and accelerating variation in the terms of homeowners' policies and other property insurance policies. There's a myth out there that all insurance policies are the same, but they're not. And despite that, it's essentially impossible for anyone who is not an expert in the area to really understand how these policies differ or vary. And in many cases, these variations can leave folks without coverage. If we had a single baseline policy that said, look, if you get homeowners insurance, this is what you have and this is what you don't have, or that at least established certain presumptive baselines, we'd go a lot further to allowing people to understand the coverage they have and the potential gaps that come along with that. We'd also actually limit a lot of claims contestation. So I think we still have a lot of work to do in terms of transparency regarding insurance policy terms. The third piece of it is claims. We have really remarkably little data and information about how different insurers handle claims. We know there's a lot of variation, but what we don't know is which insurers are more likely to pay claims quickly, are less likely to have successful lawsuits against them. And making that type of data available, that is already actually collected by insurance regulators through the Market Conduct Annual Statement, would really go a long way towards facilitating competition among insurers with respect to something that policyholders clearly care about a lot, which is, will claims be paid? Finally, we really need to think a lot more about what direct and indirect discrimination mean in insurance markets. This is an issue that folks have been talking about for years, and we really haven't made much progress in understanding that. So I don't want to talk more than my allotted time, but for each of these topics, there's a lot that can be done to further research and understand them to develop a more inclusive insurance system. Thanks.
Thanks, Daniel. Yami, over to you.
Thanks, Caroline. So brief introduction of who I am and who Swiss Re is. I'm a senior product manager within Swiss Re's public sector solutions team. And what that means is my work focuses on working with governments, public entities to provide them with insurance. And as a reinsurance, which is Swiss Re, is we actually insure insurance companies. And one of the missions that we've simply put focus on is to make the world more resilient. And what that means in today's context is helping to enable uninsured and underinsured population in society to access, afford, and use insurance as a key means to secure financial resiliency at the household, individual, and even the community levels. And my work specifically focuses on, I would say, when it comes to public entities, reducing protection gap. And that extends the areas of not just natural catastrophe, but in mortality and health. So across the spectrum of live and livelihoods and our understanding of their protection gap and what that means. Well, one thing we can't talk about, in terms of resiliency is how do we support and promote sustainability? And so the other areas of focus within my company in largely around sustainability is about not only building the societal resiliency and focusing on affordability and insurance through, driving and accepting, adopting digital solutions that are out there, but also mitigating climate risk by advancing, energy transition to actually reduce the climate overall risk to the population.
Great, thank you. Thank you all for your remarks. We're going to do a few questions now. Reese, to get us started, I wanted to dig in a little bit more on the age system and some challenges, because it's possible from the outside, it might seem like the US has a pretty robust system for disaster assistance through multiple federal agencies. But I was hoping you could elaborate more based on kind of what you and your colleagues have seen on the ground, trying to help families actually rebuild and get their lives back together. Why is that not the case? And then why does that make insurance take-up really important?
It's a great question, Carolyn. I appreciate the opportunity to answer it. A lot of folks, you see disasters happen and then FEMA starts to report the many, hundreds of millions, sometimes billions of dollars they're directing to communities. And later you see Congress make large appropriations and HUD allocate, billions of dollars to communities. And it's easy to think, oh, well, everything's just taken care of. Of course, the FEMA assistance that makes it to individuals is pretty paltry, around $4,300 per household after disaster. And the HUD assistance that comes in large, figures, hundreds of millions and billions of dollars, takes years to make it to communities, and then only makes it to some survivors, and really only those who could wait the many years on that assistance to arrive. So when I look at, troubles in the insurance marketplace, I think about flood in particular. And really the way in which the need for flood insurance in America is both outpacing the indicators for need and the demand for the product itself. So if you look in Houston and the surrounding areas after Hurricane Harvey, more than 80% of the homes that were flooded aren't in mandatory flood insurance zones. And so there's both a no indicator that people need to buy the insurance there, a sort of lack of awareness broadly throughout low-income communities about the difference between flood insurance and homeowners insurance. So, that it's a standalone product causes quite a bit of confusion. Affordability is getting ever more difficult, especially in low-lying areas where risk rating 2.0 will cause premiums to increase for flood insurance. The floor of affordability for a national flood insurance program policy in some communities is far above the ceiling of what low-income households can afford. And when families are forced to choose between medicine and flood insurance, they choose medicine. And so, the effects are then visited afterward. But Carolyn, you asked specifically about, why is insurance take up so important? I mentioned that after Hurricane Harvey, the average FEMA individual assistance payment was around $4,300. SBP rebuilt hundreds of homes in Houston and the surrounding areas. We saw average repair costs of around $43,000. So 10 times what FEMA was giving was an average repair cost. And that's us doing it with charitably raised dollars and, volunteers to help lower the cost in some ways. Meanwhile, homeowners in Houston who had flood insurance saw an average payout of more than $100,000, often plenty of money to restore or sell and move on to a place that's a little less risky. And so in that way, good gets better and bad gets worse for low-income communities. There are even fewer resources available. And the whole thing sort of continues another stage. So that's some of the challenges we're seeing: affordability, availability, awareness of the different products, and the need to have them, I think, are representative in are well represented in every community that SVP's worked in around the country.
Thanks, Ceres. I appreciate all that and that extra detail. I have questions for all the panels, but it occurred to me that I should probably let you all weigh in on each other's questions too. So Daniel or Yami, if either of you want to add to that, otherwise I can. No? Okay, then I'm going to go on, Yami. I have a question for you. The private sector doesn't necessarily have a mandate to step in and fill some of these gaps we've been talking about in terms of access and affordability. But as you noted, Swiss Re has been working with lots of partners on projects that are really trying to bring insurance to more vulnerable groups. So maybe being someone in the private sector sitting in industry, if you could tell us how you see insurers' role and how they might also be able to kind of push forward some of this agenda through maybe deeper partnerships with the public sector or others. Maybe highlight a couple examples from Swiss Re that would be useful.
Yeah, thanks, Caroline. And I think, maybe just to answer this question a little bit on commenting Reese's answer, because I think it highlights a lot of the same challenges to actually get across, I would say, the value of insurance to the vulnerable population that we actually want to engage with, right? And so first and foremost, insurance is a financial literacy topic. I mean, there's no way around it, right? And so I think even to raise awareness, it's a little bit about education. Yes, it's about actually saying, what's the value of insurance? And I think insurers need to do better with, governments to communicate the value of this insurance on their own financial health by building this resiliency that they can have access to. And I think with low income households and communities, especially, they are price sensitive, right? Reese says, if you have to choose between medicine or insurance, you're going to choose medicine. And so being price sensitive, they tend to think about, how do I budget and stretch my own income? And so the products that we have to offer them, they have to perceive it as good value for money. And that might mean that we might have to think from a product's perspective, how can we, instead of offering the existing traditional products exist, right size it for them so that they actually see that value and they're willing to go, I should try this out as potentially a solution for myself or community. And there's that human component, right? So it's when you talk about communication, it's about reaching that vulnerable population and recognizing for them, the question is, how can we work together to help you help yourself in the long run? And from my perspective, that is, you have to engage with partners. And that partnership, I think, is very broad in terms of who within communities do we need to engage with so we understand the needs of the community and their pain points better. What is stopping this, quote, affordability, accessibility, availability? Is it from a data perspective? Can we engage data providers or technologies out there that says, hey, we're not using this currently, but that doesn't mean that we can't start thinking about its application in the future. And maybe, one example, and it's in the report that you guys have, and I will just highlight it here, is, and it's a little bit dear to my heart, and I think Reese will understand, is I'm from New York City as well. And so there is a case study where New York City is piloting flood for 4 low to middle income areas within New York City and offering them flood protection, right? And the solution harnesses the power of digital, where it is actually where near real-time flood map is made available to the city. And this already moves away from the traditional flooding measurements that we have in the past, whether it's rainfall estimations or proximity to a landfall hurricane, right? And so I think that's just one example, and it's transparent, right? If you read it, I think transparency is also key to engaging the vulnerable population, because we have to recognize they have been marginalized in the past. And so how do we actually bring this full transparency to scope for them?
Yeah, and just building off of those comments and also Reese's comments, I think that in order to build trust in these communities, there are reforms that are needed, because the reality is that when you ask folks about insurance companies, they often say, well, look, there's going to be some hidden exclusion I don't know about, or even if it's covered, they're not going to pay. And so I think that having certain protections where we can say, look, categorically, every property insurance policy, this is what it covers and this is what it doesn't cover. By saying, look, if you have a claims problem, here's what you can do to get a solution. There's an independent process that is easily accessible, that you don't have to hire a lawyer for, that is independent, that can help you resolve a claim. Saying, look, you can look at how often there are claims contestations and how often not. And even if folks aren't going to actually access that information, having that information available, I think, is really important. Because right now, the fact of the matter is, most people really have very little idea what insurance covers, what their property insurance covers, and what value it gives them. And I personally think that the insurance industry has shot themselves in the foot repeatedly here by resisting efforts to coordinate disclosure and coordinate some level of consistency so that we can actually have a consistent product, have a consistent amount of procedures and system for resolving claims, and then focus competition on pricing, on underwriting, on other elements where on mitigation, risk mitigation, rather than on claims, trying to figure out how to pay less or trying to figure out how to reduce coverage more than your competitor. So I think that at the end of the day, we do need regulatory solutions, and we need regulatory solutions that are designed to convince folks from across the spectrum that these products, that they meet certain minimum safeguards, and here's exactly what they are. And right now, it's very hard to say that. It's very hard to get the right information to say that. So to me, that's a big part of the solution that we, is out there, that we have models for, that we just haven't really reached for over the last few recent years.
Thanks, Daniel, for raising that. It was what I wanted you to spend some more time talking about. And I think that's a really important point to hammer home some of these differences. I know in some prior research I was doing, I realized I didn't know much about my insurance policy, and I tried to figure out all the exclusions and sublimits, and it was surprisingly hard to do so. And I think we've maybe done a good job talking about floods not included, but what about all the other things? And just to build on what you were saying, I think one that got reported on a lot, but again, not good research, but was certainly in the news, was after the Texas ice storms. And there were all these stories of people who were like, I had $200,000 of coverage. I should have been fully, I thought I was fully insured, but I go to file a claim on my burst pipes and I'm only getting $3,000, even though I had $25,000, of damage. I just made up those numbers, but so then struggle to rebuild.
The part of the issue there is that the only answer we could give is look at your particular insurance policy, because it's going to vary. And there were a lot of variations regarding exactly how those types of claims were processed. What type of message does that send to people? That unless they read their insurance policy beforehand and they have an encyclopedic knowledge of it, this is not a trustworthy product. And we can't give out categorical messages of this is how much you should be paid, this is how much you should not be paid, here are the situations that are covered, here are the situations that are not covered. Part of the issue here, and again, as I alluded to earlier, I've done a lot of work on this, and there's no way we can cover the sort of, full landscape of issues here, but I'd encourage folks to go look at that. Is, historically, these policies were actually just de facto standardized. Really, insurers just used the ISO policy or some other standard policy. But in recent years, insurers have started just developing their own language, and that process has accelerated to the point that it's very hard to say, here's how a specific issue will be resolved. So we saw that in the Houston floods. We also saw it in Sandy too, in Hurricane Sandy, where it was very hard to say, look, here's what's covered, here's what's not covered, here's when you have a legitimate claim, here's when you don't have a legitimate claim. And if you can't come out with those clear pronouncements about what's covered and what's not, even ex post, again, that feeds frankly, the cynicism of a lot of people that these products, the only reason to get them is because someone requires them. All you need to do is get the cheapest thing possible, and that's it. It's just about satisfying, as opposed to this is an important mechanism to protect yourself. And so I think that this type of transparency, these types of setting a clear baseline scenario of here's what every policy is going to cover no matter what, here's what you do if you have a claims problem, here's a public mechanism that's easily accessible to go to help resolve that. Those types of solutions really are necessary, and they have not been implemented really in recent years.
Let me bring this back to other ways to get at these same issues through some of these innovations. And Reese and Yami, I'd like your thoughts on these, because I completely agree, Daniel, with everything you said. We're also seeing in the market, though, some new types of approaches like parametric policies that pay a set amount based on a very observable measure of the disaster, which arguably would be very transparent. Of course, can't replace an indemnity policy when you need that. But I'm sort of interested in Yami, how you see these in the marketplace, and Reese, how you see this interacting with all the other things that households are juggling post-disaster, and how they might view these types of new policies.
Yeah, thanks, Caroline. And I agree, right? I think with parametric insurance, you hit it right on the head in terms of what's the appeal, right? Especially to people who are not used to purchasing insurance, or who, like you say, for past experience, very hesitant to dip their toe again into the insurance. And parametric insurance, I mean, it really focuses on, in terms of predefining where a loss and the payout comes in. So it is, in terms of a product design, simple in terms of any future claim process, or not actually have a future claim process that is included, that is very much, I think, cumbersome in that traditional indemnity process that we have currently. So I think in terms of that transparency, hopefully this would be a tool in this toolkit for communities to start considering when they want to dabble in term. I'd like to start exploring how insurance can help my community. This could be an innovative solution that they try to pilot and understand and grasp. And what also appeals for me from a parametric sense, in terms of not only just the simplicity and transparency, but to which the payout of an insurance comes. It is, I would say, a lot faster than the traditional program. And we know that when it comes to recovery, speed and access to funds and money is crucial. And it's crucial in terms of not just the recovery process of it, but I think parametric insurance solution also allows the flexibility of how the money can be spent in that recovery. Because I think depending on the community and the type of natural disaster, your needs are going to be very different on the ground post-disaster, right? So this money can be spent in terms of scaling up emergency rescue and care. Or it can be provide temporary housing and transportation. The chart that you showed early on, Caroline, in terms of how money is spent, it's quite a long list of where the cost falls out. And so you want flexibility in terms of an insurance design to allocate where I would like to spend some of this funds are to meet those greatest needs. And I think where I also like the conversation and the progress forward with the application of insurance is for parametric insurance, it allows the shift of, I think, the mindset, because what I've just described is a recovery mindset. But I would like to challenge the audience to say, can we use also this type of solution from a preparedness mindset, right? So if we know that there is going to be a hurricane approaching, communities start thinking about, can I actually tap into insurance for an evacuation coverage, right? To get the people out of those sites that we think will be hard hit us. And so that's also a mind shift from recovery to preparedness. But I also think that these innovative solutions allow for us to have these conversations and start thinking and application of insurance much more broadly than it has been in the past.
Reese, last word from you, and then we'll have Stephen bring up some audience questions.
I'll make it a quick one. Heated agreement. I'll nod till my head falls off. I love parametric insurance. I mentioned earlier the floor of what policy premiums cost in the National Flood Insurance Program and the ceiling of what low-income households can afford. The space between those two is where parametric insurance can really thrive. If you think about what low-income households rely on now, it's that $4,300 from FEMA that I mentioned before. So it's already not an indemnity-based system, right? FEMA sends in-person inspectors to verify $4,300 worth of loss. Imagine a parametric policy that uses an easier trigger to pay a higher award in the event that it's met. FEMA would love it because now they don't need to pay the $4,300. The individual got twice as much. And all we asked was for them to engage a little bit of financial skin in the game here to pay a premium that is surely much smaller for a $10,000 parametric policy than it would be for a national flood insurance program, policy at $250,000 or whatever it is. So there's a ton of room there. And if you think about it, what parametric insurers would really be after is, can I provide more than $4,300 in less than the typical 60 to 80 days it takes FEMA to adjudicate payments? And if the answer is yes, then it seems like there's a market of interest there, not only from low-income households, but also potentially from FEMA. We know more now about risk and impact than we've ever known before. And I think individuals should look to new products like this, but FEMA and insurance regulators in various markets should create sandboxes, allow organizations to experiment with policies that'll meet the sort of missing gap in insurance protection in our country. Thrilled again for this opportunity and appreciate the last word, Carol.
Thanks, Reese. Stephen, over to you again.
Thanks, Carolyn, and the panelists. Wow, such a rich conversation. I have a list of 30 questions from me, never mind those from the audience, but I'll start with the audience questions. This question for anyone who wants to take a crack at it. Thanks for the presentation and the work on the report. Do you have a view on whether it's better for governments to subsidize premiums for those that are unmet or backstop losses, i.e. like terrorism risk insurance? For example, subsidizing premiums could be seen as subsidizing insurance companies. And just as you're thinking about who wants to answer it, I'll just give context. In April, the Florida State Assembly appropriated around $2 billion to backstop the reinsurance industry. And that was before Hurricane Ian and obviously California and others. So who would like to take a crack at that question?
Well, I'll just say this. I mean, I think right now the record suggests that reinsurance mechanisms can work reasonably well while still actually conveying to folks the underlying risk. One of the concerns I have about subsidizing premiums directly is at the end of the day, we want premiums to communicate risk, and we want them to induce risk reduction. And so I think that there are ways you can design a system where you have premium assistance that's tethered to income that will still preserve that. But look, I think if the National Flood Insurance Program is any guide, the federal government and it's not always so great at figuring out exactly how to set those rates to preserve risk mitigation. And so I'm somewhat skeptical that we can have a government-run system that sets premiums in a way that preserves those incentives. So that's sort of my sense on that front. But I'm curious what other people.
Does anyone want to jump in before I go on to the next question?
I'd agree with that. I think that it's important that premiums send accurate indicators to the marketplace about risk. At the same time, I think that means-tested assistance programs are totally achievable. And as you start to see the way flood insurance premiums will increase, particularly like in the American South, where development happened along riverfronts and low-lying areas where poor people live is often where they were allowed to live. I suspect some of the places where flood insurance premiums will increase the most will be particularly ugly, and we'll want to address just as quickly as we can how to make sure those communities have the kind of assistance they need in order to afford the only products that are available. I suspect as risk rating 2.0 settles and the federal government provides insurers and onlookers with even more information about how those pricing mechanisms work, there'll be a more robust conversation to be had on affordability programs and where and when they should be applied, or at least that's my hope.
Great, great. Let me go on to the next question. And Carolyn, we'll start with you to answer, but anybody else is welcome to jump in. Excuse me. Good afternoon. Thanks for having this webinar. I'm in Louisiana, and we've had a real problem with insurance companies no longer writing policies in certain parts of the state and insurance companies going insolvent. Not only has the property insurance increased, but also renter's insurance. What mitigation programs would you recommend we do here to help? Carolyn, if you want to kick it off, and then anybody else.
Yeah, that's an excellent question. Louisiana has been a real hot spot for sort of insurability crises potentially related to increasing climate risk. And I think it's really stressed, as in the question, how important it is that we do a better job of linking our insurance with our risk reduction activities, which includes better building codes and better land use on where we're going to be allowing development and the type of development. We know how to build safer structures. First of all, things like fortified homes. IBHS also recently came out with a wildfire standard, and yet way too often we're not building that way. And unfortunately, we're also not building that way, even when we have an opportunity to rebuild post-disaster. Too often we see communities actually rolling back codes, or households not even knowing, not having the funding or the information or the assistance to incorporate those changes at the time. So, I think there's a number of models we can start looking for here on how to do that. So one, as I was just alluding to, in the rebuilding process, making sure that our aid programs and our insurance programs are all working together to encourage, adaptation and hazard mitigation, which might be not just getting that extra payout, but having maybe a partnership with a nonprofit or a community group that can help households with the real sort of transaction costs of how to do it. What measures do I adopt? How do I find a contractor I can trust, know they're going to pay a fair price, and do all this in a timely way? So as Reese said, I'm not out of my house for like a really long time. I do believe there's a model there that we can find to work, but we haven't cracked that nut yet.
Great. Carolyn, does anybody want to add before I go on to the next question?
Okay. One thing just to add is just echoing Caroline in terms of, what she shared in terms of actually reducing overall risk. And I think from, my perspective, call to action from insurers is to recognize the effort and how do we actually support that effort, right? Because at any of those longer term mitigation actions, there's going to be a length of time before we actually see the benefit, right? In that period, how can we sort of meet at that head until we see that longer benefit, because the buildings are built up to code. We're actually we're seeing the reduction in that climate overall risk. And so I think there is also, how can insurance incentivize that call to action that, communities actually build to code and address, in this case, adapt to the climate risk that we're seeing.
Absolutely. Great point. Daniel, do you want to add something quickly?
Yeah, just one thing I would say is that part of the issue here is that so many insurers do have inherently a somewhat short-term focus, because at the end of the day, they're issuing one-year policies. And so I think measures we can take to increase the long-term vantage point of insurers to think about incentivizing risk mitigation measures that may pay off in multiple years is something that we should think about seriously.
Yeah. Another question, which actually I'll read, but then I will answer very briefly. What insurance companies were consulted during the development of the report, and what feedback have you received from the insurance industry? So we sent this to insurance companies, to regulators, and to community leaders, and got great feedback, and that led to an earlier, changes in earlier drafts. That doesn't mean that every insurance company that read it loved every single recommendation. I don't want to say that. That's not the case. Some of the recommendations are more incremental and there was broad support. Some are longer term, but we got great feedback from, again, all, and we want to continue the conversation with insurers, with trade associations, with regulators, and community activists. Also, almost every idea here is being operated by somebody now. In other words, there are great pilot programs going on. So it's not like these are, quote, new ideas that hadn't been thought of. They're put them together in the way that Carolyn and Karina did in a brilliant way, but there's a lot that we based on there. Last final question, Reese, in literally 30 seconds. You talked about 80% of the homes in Houston were not in the flood zone. Do you have a sense of what that number would be nationally, or kind of the scope of that underreporting?
It's a great question. It'd be difficult to report nationally because so much of that floodplain or the flood zone is being created by community development practices, right? Houston and Texas, that part of Texas famously, very little code or enforcement or development standards about who builds what, where, little enforcement about necessary retention ponds and et cetera. And so that kind of covering over where the water would go can create effects that are unknown even to the communities that are doing it until it happens and the runoff is then witnessed. So I'd hesitate to speculate what it's like nationally, but if it's that far off for a major developed area like Houston, we should assume it's pretty bad everywhere. And there's great innovation. You know, the work of the First Street Foundation and their flood factor tool has been really great. And I think should be able to give citizens and governments a clearer view of what's going on out there.
Thank you. So can I ask my colleagues to put the slides back up? We could easily have gone on for another hour with so much content, as our panelists said. But just want to again thank all of you for being here. There's a link going up in just a second that will would value your feedback on. So if you can do that now. We're also going to be sending out a note in the next few days that you'll get a copy of this, and we'd love your feedback on this. So because we know how valuable your time is. Next slide. Ceres is having in a month for our in-person conference. Please feel free to join us, and there's a link here, and go from there. And last slide, with deep thanks to our authors, for all the panelists, and for all of you. We look forward to working together on this challenging issue. Thank you and have a great day.